a major clash is unfolding between the old guard of finance and a rising force in decentralized markets, and the outcome could redefine who controls access to global derivatives. The decentralized trading platform Hyperliquid has surged in volume and influence, triggering formal concern from two of the most powerful institutions in traditional finance, CME Group and Intercontinental Exchange, or ICE. These giants are now urging U.S. regulators to scrutinize Hyperliquid's operations, warning that its rapid growth may introduce systemic risk into markets far beyond crypto. This isn't just about one platform, it's about the collision between centralized oversight and the unstoppable momentum of decentralized innovation. The decentralized trading platform Hyperliquid has surged in volume and influence, drawing formal concern from CME Group and Intercontinental Exchange. These institutions are urging U.S. regulators to scrutinize Hyperliquid's operations, citing its decentralized structure and user anonymity as potential enablers of market manipulation and sanctions evasion. They've formally approached the Commodity Futures Trading Commission and key lawmakers, arguing that the platform's growth in perpetual futures trading could threaten financial integrity beyond the crypto market. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. At the center of the storm is Hyperliquid, a fast-growing decentralized derivatives exchange offering perpetual futures contracts with high leverage and 24/7 trading. Its model is built on decentralization and user anonymity, features that attract traders worldwide, but also raise red flags for regulators and legacy exchanges. The platform's synthetic asset markets, known as HIP-3, mirror traditional financial instruments like oil benchmarks, allowing traders to gain exposure without owning the underlying asset. This design enables global access, but operates outside centralized compliance frameworks. The impact extends beyond crypto. CME and ICE argue that Hyperliquid's rise could affect stable commodity markets like oil, where synthetic exposure might influence real-world benchmarks. The platform's integration with major U.S. crypto infrastructure, including partnerships with Coinbase and Circle, brings it closer to mainstream finance. While U.S. retail investors remain restricted from such leveraged products, global traders are active, and the HYPE token's volatility reflects mounting regulatory and market pressure. What makes this situation different is the nature of the threat as framed by CME and ICE. They're not just complaining about competition, they're sounding alarms about national financial integrity. Sources close to the discussions, cited by Bloomberg, suggest that the surge in Hyperliquid's activity could be exploited by state-backed actors to manipulate oil futures or bypass U.S. sanctions through anonymous transactions. That's a serious claim. It positions a decentralized trading platform not just as a market competitor, but as a potential vector for geopolitical risk. But there's no public evidence yet of actual manipulation or sanctions breaches tied to Hyperliquid. The platform itself hasn't been charged with wrongdoing, and its team hasn't commented publicly on the allegations. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The next signal to watch is whether the CFTC opens a formal inquiry or whether lawmakers introduce legislation targeting decentralized derivatives. That would confirm this isn't just industry lobbying, it's the beginning of a regulatory front. For now, Hyperliquid stands at the intersection of two worlds, one built on trust and compliance, the other on code and autonomy. How this plays out will shape not only the future of crypto derivatives, but the balance of power in global finance itself.